Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest, and they're here to talk about their new book, one of the world's top global macro experts. And the new book is Broken Money, Why Our Financial System is Failing Us and How We Can Make It Better. Lyn Alden, thank you for joining me again.
Happy to be here. Thanks for having me.
So, Lyn, we're recording this interview on Thursday, October 12th, 2023. The dollar index is at 106.57. It's rallied a lot lately. Shockingly, also, the 10-year U.S. Treasury yield has gotten to, I think it hit an intraday high of 4.7%. I think it's down a little bit after that, but it's trending a lot higher compared to what a lot of the experts think. But first, before we talk about some of that and debt-based money, debt-based fiat currencies, the problem with the current system, I'm going to get your thoughts based on your new book about the past history of money and how did we get to this mess based on the past?
So I think a lot of the mess we find ourselves in actually kind of starts with the telegraph, the telecommunication age. And, some technologies, when they come around, they're all good. Whereas other technologies, they obviously come with a lot of good, but then they open up kind of arbitrage problems. And so if you step back before then, before the telegraph, there was very limited way to send information faster than people could move, other than like fire signals in the night and that kind of stuff. There's just not a efficient way to send long distance information. And so money moved at about the same speed that information did. And so for thousands of years, you had kind of two vectors of better technology over time for money. So one was the underlying commodity itself. So as humans got better and better technology, they kind of gravitated towards the hardest money, which is gold. So they went from, say, shells and limestone and furs and livestock and things like that up through, kind of the whole set of commodities towards gold. And the other one was better and better bookkeeping and financial instruments. And so they would set up kind of channel-based papyrus and paper-based bills of exchange to allow for the more efficient movement of money via abstraction, kind of like the early types of banking, or at least like money changing and things like that. Then with the invention of, first you went from papyrus to paper to then like book binding and then the printing press. These allowed for just more and more complex arrangements. But it really was the telegraph that kind of ushered in this current era, because with the telegraph, transactions could, go around the world at the speed of light, but physical money like gold still had to be sent, shipped, verified. It's actually pretty hard to verify large amounts of gold are indeed gold down to the core. And so you had very little gold move compared to how many claims for gold were moving. And so the system ended up being levered like 20 to 1 because it didn't get enough tests. Like people didn't want to pull out their gold. Instead, they were always very happy to move the claims around. And once you went into the world wars and then once you went into the modern era, they end up just dropping gold altogether. And so we've been in this environment of, it's the first time in history where we kind of took a step back in monetary hardness, because this is the first time where speed is a highly important variable for money. And so we've been in this kind of weird environment where the Federal Reserve's kind of the global ledger for the world, and then you have 160 different or so fiat currencies, and each one has a local monopoly in their country. Most of them have, little or no acceptance outside of their country. So it's kind of like a barter system, and they have a lot of locks around their financial border, basically. And so that's kind of why I call the book Broken Money, because, as bad as money can be for us in developed countries, it's even worse if you're in developing countries. You're dealing with money supply growth that could be 20, 30, 40, 50% or more per year. And so not only are savings constantly getting diluted, but your wages are constantly getting diluted. Like you're constantly trying to keep up with your unit of account, let alone your savings. And so it's rough out there in the world of money.
So currencies and currency exchange rates, it's all relative, like you said. So yeah, the dollar's been devalued a lot the last 2 or 3 years. It's been devalued, I think, over 97% since the Federal Reserve Bank was created in 1913. But if you live in Venezuela or you live in Zimbabwe or you live in Argentina, on a relative basis, your government, your central bank is devaluing a lot faster than the Federal Reserve Bank is.
Yeah, if we go back to if we define the start as the creation of the Federal Reserve, as bad as the dollar was, it was probably about the second best performing currency during that time after the Swiss franc. Uh, most currencies, most developed countries' currencies had bigger issues, and then of course, most developing currencies not only did they have issues, most of them have actually failed within the past 100 years. Like they've been failed and reset. Like they've either hyperinflated or near hyperinflated. Um, and so it's really been a problem for people to save money and to avoid the constant pressure of getting diluted, um, not just your savings, but also your wages.
Yeah, I agree. Most people don't study financial history. There's not even a lot of financial professionals that look at this. For an example, I think Brazil has had about a half dozen hyperinflations in the last 60 to 80 years. So in the last 60 to 80 years, there's been massive amounts of hyperinflations. So if you're a younger Brazilian, you haven't seen a hyperinflation, but if you're an older Brazilian, you've experienced this mess. So on a relative basis, and this is why in those countries, the dollar is looked at better. So there's kind of a black market dollar system. If our listeners go on vacation to Argentina or other countries, there may be a black market dollar system and people are not saving in the local currency.
Yeah, and that's true in a lot of countries where they have street markets, gray markets, black markets, different types of legal status in different countries, and the countries are still generally able to maintain a currency monopoly for the most part because they still have pretty good grips on their borders. Um, and so obviously you can only bring limited amounts of cash through an airport. They can control wire transfers and things like that. So they've had historically a pretty strong lock on so that when dollars come in, they kind of flow up to the top, and there's only so many available to people. One of the things I cover in the book is that some of these more recent technologies, whether it's Bitcoin or whether it's things like stable coins, are starting to perforate those borders more. So there's more direct ways to get global assets to people in countries where historically either physical dollars or wire transfers could be blocked. And so now anyone with a smartphone can find ways, depending on how tech savvy they are, to get stablecoin exposure, get Bitcoin exposure, things like that. And if they're relying on something like stablecoin, they're obviously relying on something that's centralized, but that central hub is outside of their country. So basically, for the past several decades or longer, we've not really had true competition in money, in the sense that although currencies compete on the global stage, if you're in one of these countries, you have very limited options to hold other types of money, usually. Um, and the recent trend is kind of going against that. Basically, it's like now things like stable coins are like offshore bank accounts for the middle class. And Bitcoin is, like digital gold in a way. And so as these technologies become either larger, more liquid, more robust, more understood, they start to kind of chip away these artificial barriers that are around these 160 different currency monopolies.
So I tend to see things, and I've been covering central bank digital currencies and the technology developing and worst case scenarios for Bitcoin and blockchain technology since 2015 and 2016 on my YouTube channel. I was doing it before a lot of other people. People thought I was nuts back in 2015 and 2016 with cashless society and covering these central bank digital currencies. I kind of see it as governments and central banks versus the free market, because governments can force on their own citizens legal tender laws, but then the free market is deciding, hey, wait, if you're in our local currency, for example, if we're in Argentina or we're in Venezuela and our local government and central bank, they're super corrupt. They're going to print extra for themselves. Our elites are going to take out enormous amounts of debt in the local currency, inflate that debt away, destroy our currency, destroy our savings. But our elites are all invested outside the country, but they can force legal tender laws on us. It seems that like the governments and central banks are the ones that are fighting the free market on this.
Yeah, and it's one way of putting it is that, software has obviously changed a lot in recent decades, and that's the first technology that really kind of challenges the government. So prior disruption was mostly disrupting older companies, right? So, email and the internet upsets the paper industry, for example. Whereas because this is now software money or software ways to transfer ownership of assets, whether it's dollars or T-bills or even equities, for example, that challenges this monopolies that countries want in their jurisdictions. And so now they have a much bigger uphill battle going forward. Pandora's box is open. And so if they want to keep their citizens kind of locked in financially, they have to use more and more barriers to do that. But that also slows down their economy. Like if you have all sorts of controls on your internet, if you have controls on communication, if you do that kind of stuff, it limits your growth. So
Well, for example, then are you referring to something like China, which has a social credit score, which has enormous capital controls on people getting their savings out of the country and into other currencies then?
Yeah, that's an example, and even that one is leaky. I mean, people still get money out. There's still people in China holding Bitcoin, even developing on Bitcoin. But it's obvious that they have a stronger lock than most other countries. But it's also it limits their currency reach. So, for example, their currency is, I mean, technically it's the biggest money supply in the world by dollar size, and they're along with the US, they're one of the top two economies in the world, but their currency is not nearly as accepted as the dollar, in large part because of their capital controls and their overall issues like that. So as they try to de-dollarize, one of the things that gets in their own way is their own control structures. And weaker countries, China's has a lot of power, whereas, for example, we've seen when Nigeria cuts off crypto from its banking system, or when they try to reduce their cash exposure, when they try to launch their CBDC, it's a lot harder for them to be successful. And so Nigeria's CBDC, for example, has lower adoption than like Bitcoin and stablecoins do in Nigeria, despite the fact that they've kind of cut off those from their banks. And so it just kind of shows the difficulty that most countries have against these increasingly there's more and more ways for financial assets or monies to kind of pierce into their borders.
So it seems that people in emerging markets, developing countries, even places like the United States, Canada, European Union are using more crypto, at least they're saving in more crypto. And I know a lot of younger adults, millennials, Generation Z are doing that. They're saving a lot in Bitcoin and cryptocurrency. But do you think then that governments will crack down on this even more? Are there going to be even more types of legal tender laws, more capital controls? Because it seems that the free market, people are voting with their currency. They're voting with their savings that they want to start diversifying away from these fiat currencies that we have now. But then normally governments don't like things like this. And that's why legal tender laws are there in the first place, that they want to force you to pay your taxes in the domestic currency. They want to force you maybe in times of war. It hasn't happened in the United States yet, although in the past it has, but we could see this again, where people are forced to put their savings into US Treasury bonds or war bonds. Do you see a scenario like that playing out where the free market is voting with their savings that they want to start diversifying out of fiat currencies, and the governments are just going to double down, triple down on worse, more draconian laws?
So it's possible, but again, it's a very uphill battle this time, because when this happened before, say around the war era, that was with gold, whereas this is now with internet money or open source money. And so, for example, you can bring Bitcoin with you by memorizing 12 words or writing 12 words down. It's much easier to move information. And authoritarian countries are a little bit, unfortunately more effective at imposing these types of things on their people. In countries where there's democracies, republics, some sort of representation, it's harder to do. In the United States, when they did it back when they like banned gold ownership, they did that at a time when they had a super majority, right? So like FDR had like 70% of Congress in his party. They could control everything, right? And so we're obviously in a very different.
He tried to stack the Supreme Court, and that most of the economic advisors were all Keynesians then too at that point, anti-gold people.
Yes, they effectively controlled all branches of the government. And Whereas today it's a very different environment. It's a very polarized environment in a lot of these countries. Younger people like these assets, and they're going to be an increasingly big voting bloc. Government's also not a monolith. I mean, right now the acting Speaker of the House hosts the Bitcoin white paper on the House government website. He's been doing that for like 3 years. A number of senators like Bitcoin, a number of presidential candidates like Bitcoin. A lot of them understand the value of stablecoins or similar types of innovation. Um, and so it's just going to get increasingly hard to do it. And I think Nigeria showed. I mean, they literally cut off from their banking system. And, one of the challenges that if you impose controls on banks, like before the invention of like say peer-to-peer fast money, if you wanted to do capital controls, you only had to impose them for the most part on institutions, and that's very easy to do. Whereas now with more peer-to-peer stuff, if you want to impose this, you have to impose it on the individual level. So the number of enforcement points is orders of magnitude higher. The control is a lot more in people's faces compared to just controls on the banks themselves that they might not even be aware of. Um, and so I think this overall that's going to be a lot harder for governments to do, unless it's like China and North Korea and countries like that. And overall, just information is hard to contain indefinitely. It's very easy for it to keep spreading and spreading and spreading, and it's a constant battle for them to suppress it.
I've studied a lot of financial history, and one of the common themes, whether it was the barter system or earlier forms of currency or money before paper money was invented in mainland China, is that there's routinely governments try to hijack whatever's forms of money or barter. They want to tax it, they want control over it, they abuse it, and then they figure out ways to siphon off or steal more wealth for themselves, their crony insiders, their friends, bailouts. Basically forms of the Cantillon effect, although now with fiat currencies and digital fiat currencies, I would argue it's even easier. Do you think that this is eventually going to stop? It's going to be more difficult for governments to cheat or abuse a money system going forward?
I think over time, yeah, and we see that the model I think to pay attention to is what happens in emerging markets when their ledger gets out of control. Um, and so very few countries, for example, ever decide to dollarize. Usually it gets so bad that the people do it for them, and then maybe at some point the government is kind of forced to like have a peg or something and have like a kind of dollarized in some way. Um, and so as Argentina's currency spirals out of control, for example, just more and more people own things like dollar stablecoins, Bitcoin, other foreign currencies. It's just they're holding less and less of their monetary value in the local currency, which accelerates the downfall. And an even more extreme case is Lebanon, where it's even further along in the dollarization approach. So the currency still exists. It's just that people are not storing value in it. Many of them are not even doing contracts or wages in it because it's hard. If something's hyperinflating, it's hard to even do business in it, and so they just go around it. And so that's the model of emerging markets. Now the question is, what happens when the major countries themselves run into sovereign debt crises, protracted inflation, that kind of thing? That's where I do think that unless someone can find a way to centralize or break Bitcoin, it's basically this thing that's there. It's volatile, it's growing, it's getting more liquid over time, and they're going to have to find a way to deal with that fact that I think more and more people are going to want to hold their value in something like that.
So let's talk about the US government problems. The history of fiat currencies, they don't teach this in schools. The history of fiat currencies is not a good one. They tend to only last a few decades, normally about 40 or 50 years is the average. I think we're over 50 years now for this dollar post 1971 when Nixon closed the international gold window. Although Americans, I think for years, gold had been banned or taxed. I think there were some exemptions with religious gold jewelry. So do you think then that this system, it's kind of on its last legs and we're looking towards another system now with the dollar standard and debt-based fiat currencies?
So, I mean, I think it's going to still take a while. Basically, I think the end game here is as so for 40 years, and this is why the system is able to last as long as it was. First of all, the U.S. had the biggest network effect of money, the most military power, reasonable rule of law, and some degree of government separation of powers, that kind of stuff. And so we had 40 years of rising public debt to GDP, but falling interest rates. And so the interest expense, especially for the past 30 years or so, has been very well contained. And the problem going forward is that as interest rates hit zero and then kind of bounced off zero, and now they're in some, whatever range they're going to be in, they're no longer falling. And so interest expense is now more uncontrolled. And so when you have debt built up in the private sector and that pops, that can be transferred essentially to the public sector. That's what we've seen in Japan. That's what we've seen in the United States. More and more of that debt as a percentage of GDP starts kind of gravitating towards the public sector. And once it's on the public sector, there's really nowhere for it to go other than get inflated away. And the mechanism for that is that interest rates eventually stop being a useful way of controlling inflation. So if most money creation is happening from bank lending, like it was in the 1970s, then raising rates really high slows down bank lending and therefore slows down inflation. Whereas if you have more money coming from government fiscal deficits and very high public debts, and you raise interest rates, although you do slow down bank lending, and we're seeing that right now, you also exacerbate those fiscal deficits. So you pour more money into the economy through that route. And eventually, if you get to the point where you're like Japan, where you have even more debt to GDP, then the interest rates are even less effective, and they might even just turn to outright yield curve control because they know they're not effective. And so when you get that type of environment, that is eventually how currencies die. But I do think that in the major currencies case, it's still going to take quite a while. And we'll see what the next era looks like. I think in a world where Bitcoin was never invented, a lot of these central banks probably have to recapitalize themselves with gold. I think they're probably going to try to eventually do that anyway, just not anytime soon. And we probably would have a whole nother restart of the system, a whole nother, kind of stabilize with gold to inspire confidence again, but then, eventually recreate the fiat currency system we have now. Whereas in the digital age, we now have also another option, which is Bitcoin. And so I think that, developing countries are going to continue to have currency problems, and then even the developed countries are now going to have increasingly emerging market-like characteristics because of how much public debt levels they have, and therefore how interest rates become an increasingly ineffective tool on managing inflation.
Well, also, while the Fed was cutting interest rates, really, in my opinions, and I've been doing interviews and experts like yourself for over a decade now, almost 1,000 interviews, somewhere around that number since 2010. I really think the rules changed a lot in the 2008 financial crisis, and it seems the rules keep changing every couple of years since. But DC, both political parties, the Federal Reserve Bank, every couple of years, the spending just kept binging and binging. I mean, we're consistently running $1 trillion budget deficits. And we had Janet Yellen back in 2013 or 2014 saying inflation was too low. Well, look, here we are 10 years later. Inflation is now it's stubbornly high. It's staying much higher than the Federal Reserve Bank expects, even with the rate hikes. So the debt, the DC spending and the deficits just kept growing. DC didn't cut back. So when interest rates were lower, they maybe could have cut spending. Maybe the Federal Reserve Bank could have turned out the debt at 30-year or longer, locked in a lower interest rate on the national debt. They didn't do that. And now here we are. We have a math problem. And then the foreigners with U.S. Treasuries, I think there's a supply and demand problem, don't you think, with U.S. Treasuries now at this point, in addition to interest payments on the national debt?
As long as the dollar to oil stays this high, yeah. So there's a few major buckets of treasury buyers, and most of the big ones are on buyer strike right now. So one option is the Fed. Another option is domestic commercial banks. They're not buying. One option is the foreign sector, but they unintuitively to a lot of people, they don't buy when the dollar index is strong. They generally buy when the dollar index is weak. And the reason for that is when the dollar index is strong, they're more in currency defense mode. They're facing dollar shortages. They're having all sorts of issues like that. And so if anything, they're selling their collateral to get dollars or to defend their currency. So they're usually either holding flat or even selling. Whereas when the dollar's weaker, that's when some of them go out and accumulate reserves and weaken their currency in the process of doing so. And And so right now with a strong dollar, there's not a lot of foreign buying of treasuries. And again, there's the banks and the central bank are not buying. And so almost all of the treasury issuance, actually basically all of it, has to be absorbed by domestic non-bank entities. So insurance companies, asset managers, households, hedge funds. These are really the only entities that can buy it. And it's, it's hard for them to buy $2 trillion of it a year. And so I think eventually, not anytime right away, but I think eventually we'll see the Fed return to the market of buying treasuries out of necessity, and that will threaten their credibility because if they do it while inflation's above target, they're going to have a really tough time explaining why they're doing that. And so I think they're going to find themselves in kind of a Bank of Japan like situation. And two things that I think will be different than Japan. So Japan, for all of their shortcomings, their advantage is that they spent decades with a trade surplus. And so they've accumulated a lot of foreign assets that they can use to buy oil or, sell and defend their currency, whatever they want to do. They've got this big positive net international investment position, whereas the US has run decades of structural trade deficits. And so we don't have that type of situation. We have a more vibrant economy. We have better geography. We do have a lot of advantages, but we don't have, from a financial standpoint, we're vulnerable. And the second point was that the whole 2010s decade was mostly a commodity bear market. But I think we've worked through a lot of those imbalances. So demand slowly grows over time. Existing, previously like older capex that brought new mines to market or new oil production to market, that starts kind of winding down. And so now we're a lot tighter on the supply side for oil, gas, uranium, copper, kind of the major things that we rely on. And so I expect that the combination of a sovereign debt crisis and a tight commodity market is going to be a lot different than people expect.
What's also different this time is Japan and China, for decades, they were enormous net buyers of U.S. Treasury, recycling their foreign exchange reserves and trade surpluses back into U.S. Treasuries. And now, like you said, it appears that China is selling net seller U.S. Treasuries, and even Japan is a net seller of U.S. Treasuries. But I think what we're starting to see now, Lyn, is that all these older U.S. Treasury bonds, and this is the shocking thing, almost no one in the financial community or bankers or even a lot of business people expected the Fed to get away with raising interest rates this high and this quickly. And now here, a lot of entities, whether it's foreign banks, foreign central banks, insurance companies, pension funds, a lot of these entities, especially banks outside the United States, private sector banks in Canada and others, they're sitting on all these older U.S. Treasury bonds and U.S. regional banks too, with enormous amounts of losses. And I think that's a potential point here that a lot of people are missing, that these Fed rate hikes are causing enormous damage to the global financial system.
Yeah, and I think it's funny. I've been a bond bear for years, but I would not have guessed that yields would have risen this far this fast. So bonds have done even worse than I would have guessed. And yeah, that does damage the collateral of a lot of entities. And that's the situation they're in now, and that's also why we've been in kind of this like limbo state in terms of the economic situation for a while. So foreign growth is pretty slow right now. The domestic economy is kind of mixed, where like things like the manufacturing PMI are down, but overall kind of GDP estimates are still decent. Labor market's still decent, and it's because we have this weird combination of like massive fiscal deficits, which are stimulatory, combined with that very tight kind of Fed setup, which is like recessionary, and they've been in that kind of like balanced phase for a while. And I think that can hold until, for example, when the Fed's reverse repo facility runs out. So that's been a source of liquidity for buying T-bills. And when that's kind of fully run out and the Fed's no longer able to kind of hold the level of tightening they have, like in terms of balance sheet reduction and that kind of thing, I think that's where we risk having a second wave of inflation.
Well, even higher oil prices or wage price spiral. I mean, there's a lot of things that can cause higher prices in the input costs. You have a lot of workers in different industries demanding higher wages and higher energy costs too, because of the lack of investment on capital expenditure. Do you expect then a bond bear market to last for years, maybe the longest bond bear market, or do you think that this is just going to be a short and painful bond bear market then?
So I mean, from data I've seen, this has already been the longest bond bear market. So it's like 3 years down in a row for bonds, which I don't believe has happened before in the US. Um, I think, I mean, if you go to longer ones, like the 70s was a long bear market, but it was punctuated by, periods of bonds rallying again. The sheer amount of supply coming to market is hard here. I think that, the initial kind of the biggest move down in long duration bonds is behind us. And now I think, we'll see what happens. But I think they're more probably range bound now or more of a slower bleed. Um, and I can see why tips are looking interesting to a lot of people. So you can lock in, say, a positive real yield with tips, and then should we get energy inflation and things like that, the tips would keep up with it. So there are some buyers that I think can rotate into bonds here, but the problem is just the sheer supply coming to market. I think is going to continue being challenging in the years ahead, and it feeds on itself. So that just means more and more interest expense. And another thing that people don't realize is that US tax receipts are so heavily tied to asset prices because of how financialized our economy is. And so when the Federal Reserve does try to tighten, or we practice some degree of austerity or something, when asset prices stagnate because of that, or they correct, that ends up feeding back into weaker tax receipts, which blows out the deficit even more. That's why, austerity works as a preventative thing to avoid getting high debt in the first place. But once you've gotten very high debt, austerity often fails to work because you just kind of create like a doom loop. Like if you try to tighten your belt, you're already highly financialized, you end up hurting your tax receipts at the same time. And that's why,
Well, so
yeah.
the other thing here about belt tightening, it's the private sector. Then with the Fed rate hikes, you have the consumer cutting back unless they can pay off their credit card bill each month. So the consumer, I would say the real economy is bifurcated, but that's important that you brought up about austerity. DC's not doing austerity. Both political parties aren't cutting back. I mean, the spending is out of control. So there's not government austerity here. The austerity here is forcing it on the private sector and consumers and small
Yeah, and even
business.
yeah, and even then it's bifurcated. So, you know, people assume, for example, that these rate hikes are going to suppress inflation, and sure, for some groups they do. But for example, in the 65 and older crowd, their spending is doing very well because they're, they hold a lot of these money markets and T-bills and things like that are paying out higher interest, right? So they're on the receiving side of these deficits. Um, their income streams are partially indexed to inflation. Now we could probably quibble around whether or not they index it to the right metric of inflation, but Social Security is indexed to basically cost increases, and so as money just keeps pouring out to certain groups, that spending still stays high, while other groups, like you point out, with credit card debt and things like that, they struggle. So I think we have kind of a tale of two economies right now. Whereas, if you're catering to a younger clientele, you're probably going to have a rough time if you're a business. Whereas if you're catering to people that, they locked in a 30-year mortgage, they've got plenty of financial assets, they're on the receiving side of these large, like $2 trillion deficits. Uh, those businesses and those with those types of customers are probably going to do pretty well.
Yeah, so DC metro area is still doing relatively pretty well, except for real estate agent sales right now because of mortgage rates, unless someone could pay all cash. But my best friend's a real estate agent, and he's taking a month off soon because, I mean, we're looking at just sky high mortgage rates. So unless someone else is a rich person is wiring the money, a family member, a parent or grandparent or something is wiring the money for a young adult married couple, a starter home. I mean, most people can't get approval for a mortgage at these rates.
Yeah, the housing market's effectively frozen. People don't want to leave their home because they have their big currency short on it. Like a 30-year low rate mortgage is basically a big currency short, and people don't want to get out of that position. But at the same time, they're very unaffordable. And so we've not seen a big price drop in real estate. It's been kind of flat and choppy for the past year, but we do see a big drop in volumes, and that obviously impacts part of the economy. Anyone who works in the turnover that relies on turnover in that industry is struggling.
So how much of a part do you think like Triffin's dilemma, the euro dollar, and U.S. Treasuries as collateral for the global financial system play in kind of propping up and maintaining the dollar?
I think that's a huge variable because whenever you have debt, you have demand for the unit that that debt is denominated in. And so when you have trillions of dollars of offshore debt, that represents demand for dollars. Now that's offset by the sheer supply of dollars that are coming to market, the fact that the U.S. constantly runs a trade deficit, which is for most countries weak for their currency, and the feedback loop is getting worse in the U.S. favor each cycle. So if you go back over this 50-year stretch, there have been three major dollar cycles, and they start causing problems at lower levels each time, and they start feeding back into U.S. markets worse each time. And the reason is because of that deeper and deeper net international investment position. So it's cumulative rather than merely cyclical. And so what I mean by that is like when the dollar had that big spike in the 1980s, that caused issues domestically, but it hurt the foreign sector a lot more because they had, a lot of debts, they had less reserves. The US did not have like a negative net international investment position. And so the US had to, they were more worried about how their industries were going to be uncompetitive and things like that. So they were pretty strong in that environment. And then when they had the strong dollar again in the late 1990s, again that wasn't it contributed to the 2001 recession along with other factors, but it wasn't like a huge impact on the U.S. And again, the net international investment position was negative by that point, but it wasn't deeply negative. The problem with this third dollar spike is that by now, the U.S. has run such significant trade deficits for so long, and the foreign sector has accumulated so much of U.S. assets that whenever we do get one of these dollar spikes, the foreign sector can sell assets, and so it freezes up our treasury market. It starts damaging our system more, and so the Fed ends up having to alleviate that at lower levels. And so this is a characteristic of an unstable system that gets weaker over time. And I think the kind of the end game is when you have structurally increasing interest expense, and then either a fiscal spiral from that, or you have the Fed turn to something like yield curve control. But then the foreign sector really doesn't want to own those treasuries anymore. And that's, kind of changes the structure of the system. I think we head in a more multipolar type of world over time.
Yeah, I agree. I think here we are now, 15 years later since the 2008 financial crisis. Total global debt, I think it went from around 200 trillion in 2008, 2009. Now we're 300 trillion. There was an enormous amount of dollar denominated debt outside the United States that has increased in that last 15 years. Also, in the past crises you talked about in the 1980s and 1990s, there was hardly any total amount of over-the-counter derivatives that the banks were trading. The banks were more strictly sticking with regular loans out to businesses and corporations and things like that. They weren't getting involved in derivatives trading. A lot of the too big to fail banks in the US weren't doing hedge fund trades in the derivatives market and placing US Treasury bonds as collateral. So I see total debt size, total amount of dollar denominated debt increasing. And now with the Fed rate hikes, I see all those older US Treasury bonds that are collateral for this debt-based fiat currency system that is just too big. I see the collateral going bad now.
Yeah, I think up to a point. I think that basically that's why the Fed is starting to pause, because if collateral goes bad, that ricochets back into U.S. markets. And so I do think that as we go forward over the next couple quarters, we probably are looking at some degree of recession, maybe in the first half of next year. But after that, I think we start looking at a second wave of inflation. And we already kind of see early signs of a second wave of inflation, like energy's firming back up and things like that. But I don't necessarily expect things to take off right away. I think that we still have a recession risk to go through. But I think after that, we enter a world of probably more energy driven inflation and other types of inflation again.
Well, also maybe against the dollar. So if the dollar is rallying these other fiat currencies that are in emerging markets and other stuff, and that's where a lot of goods are made, especially mining goods or agriculture, and then the U.S. imports those, eventually in the form of either stagflation or shrinkflation, it might not be as high levels of inflation as in an emerging market, but eventually that's going to be imported back here, and that's going to put higher input costs into global supply chains too.
Yeah, during the 2000s decade, despite the very high energy prices that happened, the US was able to export a lot of its inflation. Basically, we had like this 30-year peace dividend from globalization, right? So when China started opening up in the 80s and 90s, and when the Soviet Union fell in the early 90s, um, we had this strong trend of globalization. So basically, Western capital was united with like Eastern labor, and that combination was able to build tons of new factories in Asia, tons of offshoring. That helped drive the price of things down. Some people were affected by that negatively more than others, but basically it pushed prices down a lot. And so, despite pretty significant money supply growth, despite a commodity bull cycle in the 2000s, and despite wars which were inflationary and things like that, overall CPI was kind of held in check by the fact that there was this big deflationary force out of China and Eastern Europe and those types of regions. And I think the issue going forward is that that's now largely over. Um, and so ongoing money supply growth is more likely to directly feed into CPI growth because we don't have the benefit of structurally falling interest rates, and we don't have the benefit of accelerating globalization. Now, there's still technology driven in deflation in the sense that, AI is going to give us all sorts of productivity gains over time. But I think there's going to be like a bifurcated type of inflation. So anything that's kind of white collar is going to have probably lesser inflation because that's where we get productivity gains from things like AI. But all like the blue collar stuff, I mean, energy and, physical labor, like skilled, like, welders or HVAC installers or plumbers, and especially that energy side or supply chains or infrastructure, that kind of stuff I think is going to be quite inflationary in the years ahead because it's energy intensive, it's physical labor intensive. AI doesn't really address that anytime soon. And so I think we're going to have kind of two different worlds of, in one area, higher productivity, but in the other area, like lesser productivity, because, when you have energy spikes, that's a type of negative productivity. When you have to duplicate supply chain, that's a type of negative productivity. And so I think we're going to have these kind of two different, regions or two different themes that are kind of happening simultaneously.
Well, there's also been a lack of investment on the supply side for a lot of different commodities, especially energy and food, but also a lot of key metals. I mean, there's not enough copper, silver, a lot of other metals for a full switch over to electric vehicles for a lot of different countries. I mean, our electrical grid can't handle it. The amount of copper needed for electric vehicles and electric wiring, it's just not there at the current levels. The other problem with this, and you mentioned artificial intelligence, let's say the artificial intelligence experts are right, and it is enormous productivity gains. Well, the US economy is based on consumer spending. So if consumers don't have jobs because they're getting fired by artificial intelligence, I think they'd have to reconfigure the economy. I think there wouldn't be as much consumer spending because a lot of consumers wouldn't have discretionary income, wouldn't have jobs, and then they'd have to go either get retrained or find another job or career then.
Yeah, I think the earlier phase is that workers end up being a lot more productive. A lot of people assume that if a worker can do the work of three workers, that you end up hiring fewer people. And that can happen, but it also can mean that you have the same number of people, but you do three times as much work. I mean, an example of that is, as digital storage has gotten better over time, it's gotten 1,000-fold cheaper, for example, to make a gigabyte of storage. And instead of just like, big deflation there, we've instead, we all use 1,000 times more storage than we did before. So instead of having gigabyte drives, we have terabyte drives. And I think that, some workers obviously they already have and continue to will lose their jobs due to AI, but also I think there'll be more overall types of output because workers are using AI effectively. But
Well, maybe over the long term, yes. So over like 10, 15, 20 years, the economy will adapt. But I mean, in the short term, I don't see consumers spending more.
Yeah, I think again, I think there's a tale of two economies. So I think that if you are younger on average, that's where we're seeing already drop-offs in consumer spending. Whereas if you're spending is tied into those large fiscal deficits, then that spending holds up. So I kind of see consumer spending being middling going forward. That'd be my base case.
So as we wrap up the interview here, I want to get your thoughts then on central bank digital currencies. How worried are you about governments and central banks hijacking one of the best features of Bitcoin blockchain technology and then maybe issuing draconian laws, maybe trying to tax Bitcoin to death and then forcing regular people into a government crypto like a Fed coin or a digital dollar?
So I think it's a key risk. And in the book I describe is, it's a fork in the road. So we've had centuries of where most of the frictions of money were improved by centralization, right? So that was the trade-off, is that, we got money got easier to move around, easier to work with, but it also got, centralized and controlled and surveilled and debased. And this is the first kind of major technology that is potentially an efficiency gain, but one that is also decentralizing. And so there's really two forks ahead. It's either we start, finally being able to decentralize parts of the financial stack for the first time in centuries, or governments are able to push forward with their central bank digital currencies and get a kind of complete lock on that. I generally think that the the spread of information and the kind of the fact that you have to enforce this on the individual level, which is what makes it very hard to do and is what makes things unpopular. Like the reason that policymakers inflate their currency and debase their currency rather than pay for everything with taxes is because it's transparent to people. It's very, if we go to war and do a war tax and that war is unpopular, the people, revolt really quickly. Whereas if there's an unpopular war, but it's paid through money printing, the costs are kind of obfuscated away. And when it comes to enforcing all sorts of bans or, excess taxes on things like Bitcoin or other digital assets, that's going to be very unpopular right away with a lot of people. And so it's more like in your face. It's more like the government is admitting that that they're failing with their own currency.
Well, I would say the governments are desperate. So I've lived in the DC metro area for over 20 years. And like you said earlier in the interview, I think there are a lot of people here in DC, politicians, regulators. I mean, I've seen people at the DC Blockchain Summit, government employees speak in the Treasury Department and the Securities and Exchange and the Commodities Futures Trading Commission admit in speeches that they own Bitcoin, they like it. However, I also think there's also government employees that hate it and don't like it and want it banned or taxed to death. And then I also think there's government employees that are hypocrites that will say publicly on TV they want it taxed to death, but then they're gambling on Bitcoin and other cryptocurrencies. So I think it's kind of a divided stance here from government. So there are people that are obviously proponents of Bitcoin and blockchain, but then there's others that want it taxed to death. Because on my recent taxes for 2021 and 2022 taxes, I think there was 6 boxes on my tax returns asking if I own Bitcoin and crypto. I mean, the government really wanted, the IRS really wanted to know how much crypto I own, which exchanges. They wanted disclosures of all this stuff.
Yeah, I think the part they're going to keep targeting is that they don't like privacy. And so they're going to do their best to make it hard to have it be very private. And the kind of the biggest offense is polarization of government, which is also a dysfunctional type aspect of government. But what prevents like an FDR style kind of takeover of money is that there's no supermajority in Congress. It's a very split Congress. It's a very split Senate. It's a very split public. We also see that in Europe to varying degrees, lots of polarization there. And so it's harder to pass draconian things when the public supports something to varying degrees and when politicians themselves are split. And then the fact that, if a country that has been known for, not doing capital controls starts to do them, capital generally wants to go elsewhere. So, basically capital moves to where it's respected, if at all possible. And so I think that, some countries will continue to kind of crack down on this, and capital will continue to want to flee those areas, and it'll go towards these little hubs that set up and advertise themselves as being more business friendly, and more kind of innovation friendly. And I think that's going to be probably a theme in the years and decades ahead.
Do you think we're going to see something like Gresham's law where the bad money, so if governments try to make, they're abusing, they're devaluing fiat currency with stagflate, tax lie, or worse, maybe there's a even faster dollar devaluation with the debt problem, or they go to government central bank digital currencies where that bad money, people are just going to panic and say, I don't care if I'm a tax dodger, I don't care if I'm a cheat, I'm going to save in gold and silver, I'm going to save in Bitcoin, I'm going to get out of the domestic fiat currency.
But that's what you see in emerging markets. Now, the worse it is, the more people override, controls that make it hard to do. Because if your currency is hyperinflating, you're going to have trouble putting food on the table if you don't get out and get better money. And then if you take a step down from there, and currency is going up by, inflation's maybe low double digits every year, that's not as bad, but it's still bad enough that people are taking steps to protect themselves. And so, yeah, I think that basically the more quickly a ledger breaks down, which is generally worse in emerging markets, but I think we're going to see directionally similar things in some of the developed countries. We already have. I think people are going to take increasing steps to protect themselves. We live in the age of social media. And so, back in the 1940s, there was like political cartoons and things like that, but that information just flows so much quicker now. I mean, the government is getting memed all the time, right? Just memes kind of making fun of everything they're doing. And that's all transparent. It's all going around the internet. And so it's going to be hard for governments to maintain confidence, I think, in their systems in the years ahead. I think we're kind of in that fourth turning type of environment where trust for various institutions continues to deteriorate until there are new institutions built up. And some of those can be digital institutions like protocols, things like that.
Well, I think also the young adults in the Bitcoin community are learning things very rapidly. So they're learning things like Austrian School Economics, what fractional reserve banking is, how much the Federal Reserve Bank has destroyed the dollar, fractional reserve lending. They're learning all these terms that are not taught in school. So I think that's important. There's even ones that know what the Cantillon effect is. So, I mean, like a lot of people in financial professionals don't even know what that is.
Yeah, and I mean, part of defending against some of the tail risk scenarios of like FDR type of lockdown on money is education. So the more people that are aware of some of the stuff that's happened over decades, the harder it is to do. I mean, if inflation's happening and the government says this is happening because those like greedy Bitcoin people are just hoarding Bitcoin and they're not holding their own currency, we have to like go after them and or it's hogging all this energy. It's that's why we're having an energy crisis. It's all Bitcoin's fault. If there was no like educational resources and things like that, a lot of people could believe that and go along with it. Whereas by having educational resources out and saying, like here's how it works, here's why it's useful. People should be able to choose their own money. Whether it's, if you're in a developing country and you want to hold dollars, I think it's good that you can get access to those dollars. If you don't want to hold dollars and you want to hold Bitcoin or gold, having that option is valuable. And I think it's going to be important to continue to educate people on kind of the ethics of being able to choose your own money, being able to engage in commerce, being able to protect yourself. And I think that's part of the defense against some of those extreme scenarios, because like when sovereign debt levels get very high, you do get financial repression. This happens all the time in emerging markets. They start cutting off, their banks from, other parts of the world. They start, outlawing, some countries, like you can get arrested for holding dollars. That starts to happen in the United States. They did it with gold, and the defense against that is basically information and making sure that a significant percentage of the population knows what's going on and can see through it.
They did even worse than that in Argentina in the late 1990s and early 2000s hyperinflation. So a lot of Argentinians actually at that point, they tried to take out mortgages on using the old currency on real estate, hoping that their mortgage debt would be inflated away in the old currency. Well, the government just changed the rules and the government and the banks forced the Argentinians then to pay back the mortgage in the new currency after it was devalued. So they had to pay back in the new currency instead of the old currency they thought was going to be inflated away. And then other Argentinians thought that they would be smart if they held dollars in their local bank accounts. Well, the government and the banks confiscated those dollars and forced Argentinians that held dollars in their local banks back into the new domestic and devalued currency. So people, unfortunately, this is a history of governments. You have to expect when the economy gets bad, when government finances get really, really dicey, rules changes, bailouts, and basically stagflate, tax, lie. They're going to lie, cheat, and steal, and they're going to change the rules. And unfortunately, this is the name of the game going forward.
I agree, and I think that's podcasts like yours, and people writing about this. I think it's an important service because for a long time, those of us in the developed world have been kind of able to ignore money. It works well enough that we just kind of don't have to think about it. But I kind of like how in emerging markets, people come to learn about money more quickly. They learn how money is a market and they have to choose better monies to protect themselves. And I think that this is a lesson that people in developed countries are going to go through. And so educational resources are important, both so that people can protect themselves and to add frictions against governments as they try to do some of the the less honest type of actions to kind of, keep control of what they have.
Yeah, I don't see any good options for a lot of the governments going forward because of the total size of the debt in the system. We're at 300 trillion global debt now, the amount of dollar denominated debt outside the United States, banking system problems literally all over the globe. I think there's a lot of banks in trouble now. I mean, I would argue that at least half the global banking system now is either insolvent or close to it now, with bad losses on the loan books for commercial real estate, consumer loans, auto loans, losses on U.S. Treasury bonds. I think the losses, I was just speaking to a business contact in Canada who was telling me how bad their banking system is. So I think the governments are going to get really, really creative in a dystopian manner, in a draconian manner about rules changes and moving the goalposts. So people need to educate themselves and protect themselves with some type of diversification.
I agree.
Well, Lyn, I really enjoyed our discussion today. I definitely want to promote your book for you. Now, you have a Kindle version, a hardcover version, and a paperback version available now, but you also have a pre-order available for your audiobook, right?
Yeah, so there's a couple on Amazon. There's no pre-order yet, but the audiobook will be available by early November. On Safedeen's bookstore, so thesafehouse.com, that one does have a audiobook pre-order if you want to buy it from that route. And so yeah, there's a couple different ways to access it. But for people that just want to buy it through Amazon, look for it on, by early November, at hopefully the latest. And I'll also be announcing it on Twitter and my website when the audiobook's available. But yeah, all the other formats are already available, and people have been so far enjoying the work.
And I would agree, this is an excellent time for your book because I think these debt-based fiat currencies, total amount of debt in the system, dollar denominated debt, derivatives, all these things look broken to me. And yet the system has miraculously endured with bailouts and all these other smoke and mirror type of nonsense and secret ballots and all this currency swap line since 2008.
Yeah, I think, that's actually also kind of what happened in the 1930s and 1940s, which is that you have a private debt bubble collapse, you shift a lot of it to the public sector, and then it's that second wave where you get the more inflationary type of outcome. And I think we're seeing a similar pattern here where they were able to paper over it because a lot of the bad debts were transferred from private sector to public sector, and the issue is that once they're on the public sector, there's really not anywhere for them to go other than into the currency through devaluation or through financial repression, and that is a harder problem to kind of paper over. So I think that's going to be an ongoing issue. And it's life goes on. I mean, I just in Egypt, they were dealing with 37% inflation when I was there, and people were still driving, and people were still going to work, and people were still going to school and going to restaurants. I mean, life goes on, but you do have to take steps to protect yourself and know what's going on, and
They're
try to
probably
keep.
not saving in the domestic currency though, right?
Well, the ones that can get out of it do, but a lot of them are saving in the domestic currency and they're getting devalued. And most of them are unable to get higher wages relative to the rate of money supply growth. And so people are struggling. It's just, people are adaptable, and they find ways to get through troubling situations. And I think that's going to be just something we have to learn with going forward, is that there are going to be challenges ahead. And education and preparedness is how you navigate it.
And it's really hard to grow your income 37% or faster like that. So in the past, if the inflation rate is not too much, you can grow your income to outpace inflation to offset that. But I mean, if the inflation rate is 37% or higher on an annualized rate, I mean, it's very, very difficult to grow your income at that pace.
Yeah, absolutely.
Well, I really enjoyed our discussion. I look forward to speaking to you again in a couple months.
Thank you. I appreciate that. Thanks for having me on.